Here's something that might surprise you. The most common tax planning advice, the stuff your CPA probably leads with every single year, is actually the least powerful thing you can do. I'm talking about deductions. And don't get me wrong, deductions matter, but if that's where your tax strategy starts and ends, you're leaving a serious amount of money on the table. In this series, I'm going to show you how we actually think about tax planning and why the order in which you do things matters just as much as the things that you actually do themselves. Quick note on who this is for. If you're a high income earner, a business owner, a professional, someone who's had a liquidity event or is planning one, this series is for you. We're talking about strategies that matter when the stakes are high enough that the IRS is paying close attention to everything that you do. This isn't basic tax prep tips. This is really how sophisticated planning actually works. So here's how most people approach taxes. The year ends, the income is already recognized, the transactions are already done, and they sit down with their CPA, and the first question is, what can we deduct? And that's a reasonable question for most people, but it's actually the wrong first question. Because by the time you're asking it, most of your options are already gone. You can't unrecognize income. You can't restructure the deal that's already closed. You can't change who received the money or what kind of income it was. Deductions are what's left when everything else is off the table. They're very reactive. They work on income that's already been recognized at the wrong rate, at the wrong time, by the wrong person or entity. Real tax planning happens before all that. It happens when you're structuring a deal, when you're deciding how to invest, when you're choosing how to hold an asset. That's when you have the options. That's where the real leverage is. There are two ways to approach this. Think about it this way. Reactive planning is what most people do. The money comes in, then you figure out how to minimize the damage. Proactive planning flips that on its head. The decisions that really move the needle happen upstream before the income is ever recognized. So over the course of this series, I want to give you a framework, sort of a mental model for thinking about tax planning the way we actually do it. And I'm going to organize it around 5 concepts that I call the 5 Ds of tax planning. I tried to come up with something creative, but we'll just stick with the 5 Ds for right now. Each one represents a fundamentally different way to reduce your tax bill. And importantly, they work best when you apply them in order, starting at the top and working your way down. Deductions, as I already said, are the last one, number 5. That should tell you something. So the 5 Ds, the full framework that's shown here on the screen now. Number 1, defer is about timing. The tax code doesn't tax money that you haven't recognized yet. So the first question is always, do we have to recognize this income now, or will we control when that happens? Defer buys you time, and time when it comes to taxes is worth money. The next thing is divert. Divert is about who pays the tax. What if the income that you earned didn't have to be taxed at your rate? What if you moved it to your kids, to a trust, to a charity, somewhere that's taxed at a lower rate or not at all? In the case of a charity, nobody ever pays the tax. The full dollar goes to work. That's divert. The next one is displace. It's about what kind of tax applies. Not all income is created equal in the eyes of the IRS. Ordinary income, like you earn at a job, can be taxed at 40% or more when you add in a net investment income tax and state taxes. Long-term capital gains, 23.8%. Some income structure correctly isn't taxed at all. Displace means changing the character of that income, putting it in a wrapper where the rules are simply better, lower tax. Deploy is the one that usually gets a wait, what reaction? This is the idea that you can invest in a way to lower your tax bill. I'm not talking about tax efficient investing, that's different. I'm talking about investments that are specifically engineered to generate deductions against your other income. Things like oil and gas, real estate cost segregation, loss harvesting with long short strategies. The investment is the tax strategy. And finally, deduct everything you'd expect, the business expenses, charitable contributions, depreciation, mortgage, all legitimate and all worth doing, just not starting with that. By the time you get here in a well-planned year, the work is already done. Here's something important before we go any further. These 5 categories aren't solos. The best planning strategies often hit 2 or 3 Ds at the same time. That's exactly what we're aiming for. We want to try to incorporate multiple strategies at once. For example, the opportunity zone. It's deferring. You're deferring the gain. But it's also deploy. You're putting capital into a qualifying investment. And if you hold it long enough, you can eliminate the future gain entirely. One strategy, 3 Ds. Or something like a charitable remainder trust. That's divert. The asset moves to a tax exempt environment. It's also defer because the income that comes back to you is actually spread over time instead of hitting all at once. And so the goal is not to pick one of these Ds. The goal is to try to stack as many as legitimately apply to your situation. And so here I'll show an example of the opportunity zone kind of specifically. But one more thing before we wrap up this overview. A lot of tax planning landscape just got clarified in a major way. The Tax Cut and Jobs Act, which most people know was passed in 2017, was originally scheduled to sunset or go away at the end of 2025. A lot of these favorable provisions would have expired. Fortunately, if you're looking for tax savings, that didn't happen. The One Big Beautiful Bill Act made the most of those provisions permanent, which means the brackets, the rates, the exemptions, the planning environment we've been working in is largely locked in for the foreseeable future. That's actually great news for planning. Whether you're for higher or lower taxes, it's the certainty that lets us make long-term decisions with confidence. And the strategies we'll cover in this series are designed to work exactly in that environment when you know what the rules are going to be. One thing we're saying, and I'm not really going to dance around it, is that where you live matters a lot. State income taxes vary wildly across the country. The gap is getting wider, not smaller. Honestly, some states are cutting rates aggressively, others are moving in the opposite direction, finding new ways to tax high earners, investment income, and business owners. If you're in one of those states and you have flexibility, that's a planning conversation worth having. Doesn't mean you have to move, but it's worth having. And look, I'll say this once and move on. This isn't about whether wealthy people should pay more taxes. That's a political debate, and you can find plenty of that discussion elsewhere. This series of videos that I'm going to focus on is for people who feel they pay plenty and want to make sure they're not paying more than the law requires. That's it. It's not a loophole. It's just smart tax planning is all this is about. So once again, we're going to go through 5 videos in this series where we walk through each one in sequence, one for each D. Each one can stand on its own, the video. If you don't have time to watch them in order, you can watch one and get all the value out of it. But I recommend watching in order because it's really a sequence that tells a story. And so in the next video, we're going to start with defer because timing is the first and frankly, one of the most powerful levels in tax planning. And there's strategies in that category that most people have never heard of. If any of this resonates with your situation, if you're sitting on a large gain, planning a business sale, or just frustrated your tax bill never seems to get smaller, I'd encourage you to share this information with your CPA if you have one and ask them if you're taking advantage of all these 5 different Ds. If they can't answer the question, you need to know that. Feel free to call us too, and we'd be glad to help you. I'm David Blaine, BlueSky Wealth Advisors, and we will see you in video 1.